Hello and welcome to 5-Year Club video number 322. We're going to talk about tax loss harvesting tonight. I think it's a topic that I've covered before, but I'm just going to dedicate tonight's video to this article and talking about it because we are getting into December, and oftentimes that is when people want to do their harvesting. All right. So this guy who wrote the article, Simon Moore, he is definitely more well qualified than me to talk about it because he has a he's a chartered financial analyst, right? Which is you have to take this really difficult test to get that designation, with an economics degree from Oxford University and an MBA from Northwestern University's Kellogg School of Business. Let's see. Yeah, University's Kellogg School prior to Moolah, which is his current company, I guess. I worked at Future Advisor, a digital investment platform which was acquired by BlackRock. Okay. And he's currently CIO, Chief Investment Officer, I guess. All right. So it's a very practical topic tonight. I'm going to preface this by saying that you can benefit the most from this if you have a substantial amount of taxable investments, right? So what's a substantial amount? $5,000, $10,000, something like that. The reason why is because if you don't have enough taxable investments, then the gain that you get from tax loss harvesting is proportional with whatever you have invested. And so if you don't have enough, then the tax deduction that this is going to generate ultimately is not going to be big enough to either offset much of a gain or to get your tax deductions high enough for you to qualify for something other than the standard deduction, or for you to choose to itemize your deductions when you go to taxes. Anyhow, I'm telling you about it because once you do get further along in the game, this is going to help you to make even more money. This is one of those things where if you're paying attention and you're building wealth, this is like a really nice benefit that you can do later that's not that difficult. And so I want to, if you're not there yet, I want you to look forward to this. If you are there yet, then I want you to at least look up your own numbers, or look up kind of what your plan is for maintaining this over time, so that you don't miss out on the money, because the money is basically free. That's what it comes down to. All right, so why you should tax loss harvest now by Simon Moore. Tax loss harvesting has the potential to boost your returns without adding risk. It's not as complex as it sounds. We'll walk through how it works, where it's sensible to use, and the benefits. When you invest and your investments go up, then you often end up paying tax on the money you make once you sell. The key thing is that it doesn't actually matter whether your investment has risen. What matters for tax purposes is when you sell it. You can control when you sell your investments. That's what triggers the tax bill. That timing of the decision to sell is the key to how tax loss harvesting works. So, first of all, many investments are tax sheltered. Maybe you have an IRA. Perhaps you're investing in a 401k. Oh, come on, man. This grammar is killing me in these online articles. This is not New York Times level copy editing. These are great because the only thing better than minimizing your tax bill is not having to pay tax at all. And in many cases, the way IRAs and 401ks are set up means you often don't have to worry about taxes on your investment gains while you're in the saving phase. However, if you have a standard investment account that is not tax sheltered, then taxes do come into play. For example, maybe you made 20% on your portfolio over the past 6 months. That's great. But if you sold the investment to realize that gain, then depending on your tax bracket, what was a 20% gain could fall to below 13% after taxes are paid. If you're in the highest tax bracket, the state income taxes can matter too. Seeing a 20% return but only getting 13% once tax is paid is not ideal, and there are steps that you can take to improve the situation. Tax shelters. The first step, where possible, is to consider IRAs, 401ks, 403bs, and similar tax-sheltered ways to save. This can avoid certain taxes altogether because that's exactly why these schemes were created, to support American savers. Of course, there are drawbacks too, such as the money should be used for its intended purpose, such as retirement, otherwise additional fees and taxes may apply. Nonetheless, if you're saving for retirement and not using an IRA or a 401k to do it, then you may be missing out, and you should know your options there before getting deep into the details of tax loss harvesting. Long-term capital gains. Long-term capital gains matter too. Most investments see a lower rate of tax on the capital gain if held for more than a year. That can be a good thing. This is to encourage long-term investing, and it's a valuable incentive. In that prior example where you sold after 6 months and your 20% became 13% due to tax, well, if you'd held on and sold that investment after 12 months, then you'd see a 16% after-tax gain rather than 13%. That's quite a meaningful difference for just a few months of patience. And assuming the investment you're seeing a gain on isn't likely to see large swings in value. So remember, before we even get to tax loss harvesting, consider which tax-efficient saving options you have and whether you can sensibly wait at least a year before selling winning investments. Tax loss harvesting. Now, just to be clear, right? In what I've talked about before, the 7 baby steps order of things: save $1,000, pay off all your consumer debt. That's baby step number 2. Baby step number 3 is save an emergency fund of 3 to 6 months, and baby steps 4, 5, and 6 are invest 15% of your income into retirement, put away money for kids' college education. That's number 5, and number 6 is pay down your mortgage early. And in that scheme, the emergency fund, right, should allow you to keep the money invested for 12 months. That's the whole point of the emergency fund. It is protecting your investments from being pulled out early and suffering stupid timing losses. Tax loss harvesting. Now, if you still have savings in a taxable account, here's where tax loss harvesting can help you. If you have an investment that has lost money and ideally have been held for under a year, then you can sell it and realize that loss. Remember, an investment typically only impacts your taxes once it is sold, and if you're a DIY investor, then you control when that sale happens. So by selling your losers, you are creating a taxable loss. That's helpful. It can help reduce your tax bill either directly or by offsetting gains. You may now be asking, why bother? Surely a loss is a loss whenever you take it. Yes, that's perfectly true, but consider if you had a choice between writing a check for $1,000 today to the IRS or paying $1,000 in 2038. Though it may not seem like it at first glance, there's a big difference between those two situations based on the time value of money. Let's assume you can earn 7% a year on your money in the stock market. Remarkably, if invested to consistently earn 7% a year, $1,000 would be worth almost $4,000 by 2038 due to the magic of compounding. Therefore, even though you're paying $1,000 to the IRS in both cases, because you are paying the money 20 years later in this hypothetical example, you can earn an extra $3,000 or so on the money just by delaying the payment. That's, in essence, what tax loss harvesting does. You take your losses earlier, delay payment on the gains, and as a result, you still pay a similar total tax bill, but you pay it later. The result is that you can earn a return on the money you would have paid in tax as you keep it for longer. The result is that you can earn a return on the money you would have paid in tax as you keep it for longer. In essence, you delay paying your tax bill by making sure you realize your investment losses quickly, but your gains more slowly. Behavioral advantages. Students of behavioral investing may notice a hidden benefit here as well. Studies suggest that investors are often irrational in wanting to sell their winners too early and hold onto their losers. Perhaps because of the presence of momentum in the stock market, this can be a poor strategy, at least for the shorter term. An effective tax loss harvesting strategy has the benefit that it can reduce this behavioral bias that can end up costing many investors in potential returns. The catch, wash sales. However, it's important to know that the IRS has rules designed to stop the most basic of tax loss harvesting strategies. If you sell an investment and have bought or sold the same investment or a substantially identical one in the window 30 days before or after the trade, that's called a wash sale, and the loss can be disallowed for tax purposes. Therefore, you must be careful when taking the loss. If you've bought the same investment recently or buy it back too soon, even in a different account, then that can be a problem and eliminate the benefit. If capital gains tax rates move up and down in the future, for you based on your tax bracket or more generally based on the tax code, that impacts the effectiveness of the strategy too. Why now? Historically, most tax loss harvesting was done in December. That's potentially better than no tax loss harvesting at all, but it's not ideal. First off, your greatest losses may occur in December. For example, for this year so far, the bigger dips in the market came in February and October. Those may have been better times to sell depending on your investment. Secondly, the problem is that generally in the market following the same strategy as everyone else sometimes doesn't work out so well. This could be the case with tax loss harvesting in December. There is something called the January effect, where smaller stocks that have fallen in value the prior year tend to have a good bounce in January. Tax loss harvesting may contribute to this phenomenon, but if you are tax loss harvesting a stock, you may miss out on January gains because you need to be out of the stock market because of the 30-day wash sale rule we've just discussed. That's why tax loss harvesting now, or basically any month other than December, can be a good idea. That way, hopefully, you're back in the stocks you care about by January, having avoided the wash sale constraint in order to pick up any outsized gains. So depending on how and where you invest, tax loss harvesting may be a way to improve your after-tax returns. Learning the ropes once may help you out for decades. All right. Well, he didn't get super into the weeds on it, but basically here's what tax loss harvesting is. You invested in something that can be a mutual fund, an index fund, a stock, some kind of security, and it has dropped since you bought it. So now you have less paper value there than you had before, right? So what you can do is you can sell that, which will trigger a realized loss, which you can take as a tax write-off, or you can use to offset taxes on investments that you sell at the same time that had gains. And then you can use that money that you get from selling that asset to buy other assets. Now, as they said in the article, if you go and buy exactly the same asset within 30 days, exactly the same index fund, exactly the same stock, whatever it is, then the IRS is going to disallow that write-off. And that's called the wash sale. However, if you are selling a stock that you had a loss on and then buying a stock, maybe there's a different company but in the same industry, I think that those are substantially different because they are different companies, that the IRS could not count that as a wash sale because it is a completely different company, and different companies, they just have different characteristics, even if they have some kind of correlation in their price because of the way that different segments of the market rise or fall depending upon what's popular at the moment. January effect I've read about before. I don't know a whole lot about it. So, I don't know if it's kind of already taken into account by a lot of the algorithmic trading models. Maybe it's not such a thing anymore. But the reason why I did this video today is because I use Betterment, and Betterment tracks my investments and will automatically sell them and buy different ones when they exceed a certain level of loss. And so for me this year, Betterment has harvested about $4,500 or something, which based on my tax rates could easily be worth like $1,500 for me at tax time. And I don't know if I'm going to be able to take advantage of that exactly, because I don't know if I'm going to end up with a standard deduction. I don't really plan on selling any investments, and I don't think I have any investments that had huge gains this year because, the S&P 500 has dropped so much recently. But a $1,500 potential write-off, it's a $4,500 potential write-off, and essentially $1,500 worth of free money compared to if I did nothing. That's great. I'll take that. $1,500 can do a lot of different things. And so, it's a way of basically cutting your losses. So instead of me losing $4,500 on those, on the down market, I lost only $3,000. And that's sad, but, the stock market is volatile. It goes up, it goes down. In the long run, it's more profitable than any of the other options, at least any of the other options that people can predict. So in the long run, it's definitely going to be a good deal. But in the short run, I have to accept that there will be times where I'm down, and now is one of those times. So I'm going to pay attention to this, tax strategy and save myself $1,500 and keep going. And that's $1,500 more that I can invest for my entire lifetime. To, I don't know, someday help people with education or whatever I want to do. All right, well, that is it for video number 322. If you hadn't heard of tax loss harvesting, I hope this was helpful. And if you had heard of it, I hope that you're already doing it, or you're thinking about doing it, or you're at least running the numbers for yourself to see if there's anything you can do there. Remember, retirement accounts, they're not going to do anything for you. It's money invested outside of retirement where you have the potential to take that as a tax write-off, but only as long as you sell that investment during this tax year. All right, well, have a fabulous evening.